Hi, I'm Saddam Hussain here. I welcome you all to CBSE Board Economics. We're discussing money and banking. We discuss all the functions of the central bank. Those functions are monetary authority, banker's bank, banker of the government, lender of the last resort, custodian of foreign exchange reserves. And the last function of the central bank also we discussed, that is monetary policy, money supply and credit control policy of the government. Since we cannot discuss all qualitative and quantitative instruments in one video, it becomes too lengthy. We divided them into small parts. It becomes much easier for you to understand. So under monetary policy, what exactly is monetary policy? I told you monetary policy is central bank's money supply and credit control and expansion policy of the central bank, RBI's money control and credit control or credit expansion policy or money expansion. Monetary policy is central bank's money supply and credit control. Under monetary policy, and two instruments are there, quantitative instruments. Under quantitative instruments, the first one you have is bank rate. The second one you have is varying reserve ratio. Under this you have CRR and SLR, we'll discuss it later. And the last one is varying reserve ratios, and the last one you have is, okay, let's discuss this one, bank rate. Under monetary policy, what exactly is bank rate and what does the central bank do with the bank rate to control money and to expand money in the economy? What exactly is bank rate? Let's understand. There are four concepts. One is a bank rate, a repo rate, reverse repo rate, and interest rate. We learn what exactly these different rates the central bank adopts to control money supply. One is bank rate. What exactly is bank rate? Bank rate is, we already know that the central bank helps the commercial banks in providing short-term and long-term loans. We discussed it, and we discussed also central bank is lender of the last resort. If there is any financial crisis in a commercial bank, they go to the central bank for help. That's why it's called lender of the last resort. So the first one you have bank rate. What exactly is bank rate? Bank rate is the rate of interest charged by the central bank on commercial banks for long-term credit. When the commercial banks take from the central bank loans, the central bank charges on them bank rate, that is for long-term credit, long-term loans, maybe for 50 years, maybe 400 years, maybe 20 years, long-term credit, that is a bank rate. Bank rate is the rate of interest charged by the central bank on commercial banks for long-term loans, long-term credit. Same way you have, what exactly is repo rate? Repo rate is also rate of interest charged by the central bank on commercial banks for short-term credit. The only difference between bank rate and repo rate is bank rate is for long-term credit and repo rate is for short-term loans. The third one, what exactly is reverse repo rate? Reverse repo rate. What is reverse repo rate? When the commercial banks have excess money with them, they deposit it with the central bank. And the other way around, the central bank gives interest to them. That we call it as reverse repo rate. Reverse, the other way around. Reverse repo rate is the rate of interest paid by the central bank to the commercial banks when they keep their idle funds with the central bank. That is reverse repo rate. And what exactly is interest rate? Interest rate is the rate of interest charged by the commercial banks, not central bank, on their customers, on their clients, on the general public. That's the interest rate. I repeat once again one line. What exactly is bank rate? Bank rate is the rate of interest charged by the central bank on the commercial banks for long-term credit. What is repo rate? Repo rate is the rate of interest charged by the central bank on the commercial banks for short-term credit. What is reverse repo rate? Reverse repo rate is the rate of interest paid by the central bank to the commercial banks when they put their idle reserves, cash, with the central bank. Reverse repo rate. And what exactly is interest rate? Interest rate is the rate of interest charged by the commercial banks on the general public when they take loans from it. When the firms take loans from the banks, ICICI or SBI, suppose Reliance has taken a loan of $50 billion from ICICI Bank, the bank's charging loan on Reliance company, that is called interest rate. How do these concepts help in monetary policy? Monetary policy is money supply and credit control. The central bank has to see whether there should be more money or less money in the economy. How do they help? In case of excess demand or inflationary gap, too much prices are going up. That means there is too much demand in the economy, excess demand, inflationary gap, inflation in the economy. What the central bank does, the central bank or RBI wants to control credit, wants to control cash in the economy. Otherwise, it leads to multiple chain effect. People keep on demanding. Aggregate demand is going up. The central bank's main motive is to reduce the aggregate demand, to control the aggregate demand. How does the central bank does with this bank rate? What do? They increase the bank rate. When the bank rate is increased, they increase the bank rate, they increase the repo rate, short-term credit and long-term credit. They increase both bank rate and reverse rate. When the bank rate and repo rate is increased, automatically the commercial banks have to take loans from the central bank on high interest rate. What the commercial banks do? They also increase their interest rate on the public. When the interest rate is increased, automatically it will discourage the people to borrow money from the banks. When they are borrowing less money in the economy, there is less inflow of money in the economy. As a result, aggregate demand will come down. That is, consumption expenditure in the economy and investment expenditure comes down. As a result, when the AD comes down, we can control inflation. We can reduce the inflationary gap. It will reduce the inflation in the economy. Our price of the commodities will come down. What do? Reverse repo rate. They encourage the commercial banks to keep the money with the central bank. So reverse repo rate also increased. They increase. Central bank increases the reverse repo rate. As a result, commercial banks, instead of giving loans to the public, they put it with the central bank. Automatically, AD will come down. So we repeat once again, bank rate under monetary policy. What is bank rate? Bank rate is the rate of interest charged by the central bank on the commercial bank for long-term credit. What is repo rate? Repo rate is the rate of interest charged by the central bank on the commercial banks for short-term credit. What is reverse repo rate? It is the rate of interest paid by the central bank to the commercial banks for depositing their idle cash or reserves. And what is interest rate? Interest rate is the rate of interest charged by the commercial banks on the general public. How do these help in the monetary policy? How do these help to control credit and to expand credit? In case of inflationary gap, in case of excess demand, when AD is going up, when there is inflation in the economy, the central bank increases bank rate, the central bank increases repo rate, the central bank increases reverse repo rate, the central bank also increases the interest rate. When all these are increased, automatically it will discourage the credit creation. Automatically AD will come down and inflation in the economy will come down. The other way around, how does these help in case of depression in the economy or recession in the economy or deficient demand or deflationary gap? When there is depression in the economy or recession in the economy, it means that the price of commodities are coming down. We discussed already, output is falling down in the economy, income is falling down, employment level is falling down. This is a very dangerous situation in the economy. Why all these are falling down? Because there is no demand in the economy. Aggregate demand is coming down. When AD is coming down, it's very dangerous. The central bank has to increase the aggregate demand. What do they do to increase the aggregate demand? They decrease all these. Bank rate is decreased, repo rate is decreased, reverse repo rate is decreased, interest rate, when all these decrease, automatically it will encourage the people to borrow money from the commercial banks. As a result, consumption expenditure in the economy will go up, investment expenditure in the economy go up. As a result, AD will go up. Once again, output will increase, income will increase, employment level will increase, and we can control recession or depression in the economy. So this is all done through aggregate demand. So sometimes the central bank tries to increase the aggregate demand, sometimes they try to decrease the aggregate demand depending upon the economic situation. So lastly, for the final revision, bank rate is the rate of interest charged by central bank and commercial banks. Repo rate is the rate of interest charged by central bank on the commercial banks for short term. Bank rate is for long term credit. This is for short term credit. What is reverse repo rate? Rate of interest charged are given by the central bank to the commercial banks. Interest rate is the rate of interest charged by the commercial banks and the public. When there is inflationary gap, when there is excess demand, when there is inflation in the economy, when there is increase in aggregate demand, the central bank increases all these to discourage the credit creation, to bring down the aggregate demand. When there is deflationary gap, when there is deflation in the economy, when there is recession in the economy, when there is depression in the economy, when AD is coming down, the central bank tries to reduce all these so that it will increase aggregate demand. I'm sure you must have followed it. Till we meet next time, it's goodbye from Saddam Hussein. Bye-bye.